Jeff, uh, let's turn to our last article, and it's called Wait a Minute, the dollar and the Fed's bank reserves are directly not inversely related. Now, 10th grade English class, I practiced my signature, but even then, it sunk into me that you shouldn't use too many negatives in a single phrase. Of course, that doesn't make no never mind to me. Nevertheless, I pose it to you. What do you mean, what is backward? What is directly not inversely related?
Yeah, the bank reserves, right? That's printing money in the common conception. Therefore, given how the dollar behaves in terms of global liquidity, global money supply, you would expect that the dollar would be inversely related to the Federal Reserve or Federal Reserve's balance sheet and their, especially its remainder in bank reserves, because that's the money that's been printing. If we start with, look, what Jay Powell did from late February on until the middle of May was nothing short of extraordinary. But that was the point. In his mind, he has to make it seem extraordinary because his entire monetary policy structure is built up upon expectations, influencing expectations. Shock and awe. That's really what the Fed is. And so, yeah, it was 1.65 trillion in additional bank reserves in a 12-week period, which I believe, going off of memory, was not quite 3 times what Ben Bernanke did in October and November of 2008, which, again, I think that was his point. I'm bigger numbers. It's much more impressive. Look at this flood of bank reserves. Now, whether it's a flood of money, if it was a monetary flood, shouldn't the dollar fall as Jay Powell is adding all of this liquidity, flooding the system, as he said? Wouldn't the dollar fall? And therefore, we would expect the level of bank reserves to be inversely related to the dollar's direction. As Jay Powell floods the system with liquidity, that relaxes the shortage, and then eventually you would expect that it would alleviate the shortage entirely, pushing the dollar down and down and down. But what we see instead is that the dollar goes up, then bank reserves go up in the same direction. So again, going back to our leaky bucket analogy, what's really happening is Jay Powell is seeing the level in the bucket fall because it's already leaking. The leaks are very large and a lot of water has flown out. And so he's trying to add water back in using the only tool he has at his disposal, which are bank reserves. And what you end up seeing then by that direct relationship is that the Fed is nothing more than a reactive policymaker trying to influence expectations, not adding liquidity, but adding the perception of adding liquidity and hoping that people buy it. What the dollar going up and then staying up says is that in the marketplace where it actually matters, nobody bought it because there was no real flood.
Jeff, then the dollar starts going down, and so does the balance sheet of the Federal Reserve. Why are they pulling back? What's going on?
Well, again, we talked about before, this midpoint in mid-May, is a very important signal in what's going on in the markets and the economy, because that's when reopening started to really take shape and where it became a real possibility. And so that took a lot of pressure off of the global dollar system, simply because, well, first of all, commerce was being restarted. Therefore, dollars were actually flowing through the system, through the global system again, number one. Number two, it was a sentimental boost because now it's like, okay, we've been through it. We've gotten through the worst of it. Maybe it does get better from here. Forget Jay Powell, just maybe the economy does start to heal. So for whatever combination of reasons that had nothing to do with Jay Powell, the dollar system started to get a little bit better, at least less of a negative, less negative pressures behind it, which in our analogy means some of the leaks were smaller. The bucket's still kind of leaking, but it's not leaking at the same pace as it was before. Now, what that did to monetary policy was that reduction in financial and monetary pressure allowed him to scale back his own activities. QE was pulled back. Yes, they were still expanding their balance sheet, and most of that cash was going into the Treasury General Account, which unfortunately we won't get a chance to talk about today. But look, the level of bank reserves, this flood of money into the banking system that we keep hearing about, all of a sudden that goes down too. So as the dollar is falling a little bit, slightly, because of this reopening process, that leads the Federal Reserve to be reactive yet again by pulling back on the throttle, at least their conception of the throttle, because there's not the same amount of pressure. And so both up and down, dollar and bank reserves, the relationship is a direct one when it should be inverse, right? Again, if the Fed is flooding with the world with bank reserves and they're pulling back, think about quantitative tightening, all that crap they talked about before all this happened in 2018 and 2019. If the lack of bank reserves or less bank reserves is tightening, why wouldn't that push the dollar higher? And the reason is because the Fed is simply reacting to the marketplace and trying to influence economic and financial agents' behavior so that they then act in accordance with these monetary policy signals. Because when you look at it, when you get down to it, as we saw in 2008, as we see again in 2020, the monetary policy is not about money, it's about expectations and about signals. Bank reserves are simply an accounting fiction.
You just mentioned the US Treasury's General Account and that we won't have enough time to it, but I think we can discuss it because it's somewhat pretty simple, I think, and it's something that you've been discussing before. I'll just set up the scene. The U.S. General Account is the United States government checking account. It's held at the U.S. Treasury, and it's approximately 3 times higher right now in July 2020 than it was at any point during the last 244 years. It could be inflationary, but like reserves and the correlation, it's directly correlated to trouble. Not that this is going to be inflationary because of the leaky bucket.
I think there's a lot of confusion about the Treasury General Account because it's somewhat backwards. It's somewhat convoluted because of the way the accounting actually works. When the general account balance goes up, that's actually taking bank reserves away from the banking system. And so the rise in the general account balance is in the common perception, draining of liquidity. That's exactly what the Federal Reserve attempted to use it for back in 2008 when they were convinced there was too much money during the worst monetary panic in 4 generations. Again, another way to demonstrate how these people are so completely clueless about how the system works. They actually believe they needed the Treasury to take bank reserves away from the banking system during a monetary panic. That's how bad these people are. But that's accounting-wise, that's exactly what it is. Every dollar that goes into the general account is a dollar that can't be used by the banking system. So what has happened over the last couple of months is that the Treasury has been building up this massive pile of cash in its cash equivalent in its Treasury General Account. I think it's over 1.6 trillion. That's how much cash the federal government has to spend. That's 1.6 trillion that the banking system doesn't have available for its own uses. So the Fed has expanded its own balance sheet, its overall balance sheet, to accommodate essentially 2 floods. There's the first flood, which we just talked about, which was the bank reserve, the increase in bank reserves that you can see in the banking system. And the second flood is this rise in the Treasury's General Account that essentially is cash that is currently locked up in the government's hands waiting to be used. And that's what people are saying is inflationary, is once that 1.6 trillion in cash is then spent by the government in whatever fashion, it gets released back into the economy, there's another inflationary pressure that will certainly destroy the dollar and blow up the Treasury market. When in fact, you have to ask yourself first, why is the government holding that much cash to begin with? What are they thinking? What are they preparing for? This is essentially a rainy day fund. It's not a monetary policy fund in this case. There's no cooperation with the Federal Reserve. But why are they holding 1.6 trillion in cash? What are they preparing for?
It's not what I'm showing right now in the YouTube simulcast is the last graph of your article here. And it goes back to our big theme of the leaky bucket. They're preparing to fill in all of the GDP that's been lost already. And one of your articles, maybe a month ago or so, maybe 2 months ago, you did a forecast of how much GDP the United States is going to be short, and you came up with roughly 3.4 trillion relative to the 2020 baseline. And so there you go. The government's got 1.6 that they're trying to fill in, and the whole is 3.4 trillion big. just rough numbers, but it gives you the sense.
Yeah, I think that's the point, right? I mean, we're not talking strictly monetary now. We're talking about in real economy. What's been lost in GDP when we're talking about nominal GDP, that's spending that doesn't happen, that's profits that don't show up, that's earned income that people don't earn, it's investment that won't get done because companies are hurting and laying off workers and all these other bad things. That's the economic bucket that has already leaked out, by the time we get to the end of the year, something like, say, 3-4 trillion, whatever it ends up being, a massive amount. What the federal government is attempting to do is to fill some of that in to hopefully keep the economy in at least somewhat of a reasonable state, so that when we do get to some kind of recovery, it can actually be a recovery, that we're not going to suffer any more economic second and third order economic effects for this massive hole in the economy that's already been created. That's what that 1.6 trillion is for. And as you put it, Emil, they're trying to put that back into a bucket that's already leaked out, something like 3 trillion. So it's not inflationary. It's an attempt to offset deflation that has already happened, as we saw in the CPI, and is likely to continue to happen as the economy gets past only its reopening phase and starts to experience more of the purely economic stuff.
Jeff, do you think that in the next week, the monetary and economic Humpty Dumpty is going to be put back together?
In what way?
Just
the whole thing?
Yeah, that's right. The whole thing. The whole thing.
No,
if not, go ahead.
No, okay. What I was going to say is that, look, in the history of these things, once Humpty Dumpty gets broken, that's it, man. I mean, that's what really 2008 was. I mean, the first global financial crisis was, Humpty got a little bit of a crack on his shell on August 9th, 2007. And from there, the crack the fracture just proliferated throughout his entire body. And by the time of Lehman Brothers, Bear Stearns, Humpty was screwed. There was no putting him back together. He was going to be completely destroyed. Once these things happen, once these behaviors start to change in the monetary system and the financial system, there's no really getting them back until enough leverage and enough risk-taking and enough bad behavior gets expunged from the system. And the way it gets expunged from the system is through deflationary type processes, monetary destruction, the leaky bucket. When enough water leaks out of the bucket such that we can then get to reach an equilibrium in a much lower state. I think once that process begins, once the first bucket shows up, or once the first leak shows up in the bucket, the Fed doesn't try to repair the leak. It tries to add more water back in.
Maybe we can use the little pieces of Humpty Dumpty and plug the bucket up. But if it's not done, and then
you have to figure out the right pieces. Do we have to figure out Humpty's anatomy? I mean, it's a good analogy, because that's what we're talking about. Because when we look at the dollar system, there's not one dollar system, or there's not one feature that we can focus on. There's all these different pieces: repo collateral, FX, all of these different monetary markets that make up what seems to be, or what used to be a monolithic whole. There's really all these different kinds of leaks that, maybe it would take a different kind of policy or different kind of looking at the problem to plug this leak versus to plug that leak. And I think that's really the point, is it's not just one leak we can maybe plug. There's all these different leaks that, they're related to each other, but they're not exactly the same either.
Well, then, that's good news, because that means we're going to be able to do another show. If it's not going to be fixed by next week, then we'll do another show. So I invite the audience to come back, and we'll check up on the economy and where the monetary order is going, and what's not being discussed in the mainstream financial press. I'll talk to you again next week, Jeff.
Okay, Emil, take care.